Markets have reacted bearishly to the news China is raising interest rates by 25 basis points. And I'm joined by the chief Asian economist at the private banking sector at Credit Suisse, Joseph Tan. First of all, Joseph, what do you make of the timing of the announcement? Because most were expecting it at the weekend.
Well, I think with respect to China's latest 25 basis points of rate hike, it is certainly late in my view, because it should have happened given that we do see inflationary pressures still threatening the economy. It should have happened sometime in June instead of actually come in July. But going forward, again, we still think that we are likely to see another two more rate hikes of 25 basis points each. And that, of course, will bring the interest rate closer to 7% by the end of the year. And I think largely it's because, over the weekend, this coming weekend, people are very much expecting that inflation will come in on the high side in China. So we are certainly not out of the woods yet when it comes to inflation for China.
Many think that monetary policy tightening will lead to a slowdown in China's economy. Is that a view that you share?
Right now, at this moment, we're still not convinced that the hard landing scenario is going to happen for China, because we tend to track the figures in China quite closely. And if you look at the Purchasing Managers Index, for example, which is typically the leading indicator for manufacturing activity, it tends to weaken from the months of May through to August, possibly coinciding, of course, with the power rationing that tends to take place during the summer months. But we certainly expect a rebound in terms of economic activity in the second half of the year. And one of the key reasons why is, if you look at the surprise, of course, in terms of the US ISM as well, the most recent figure seems to suggest to us that markets have been pricing way too much negative news. Obviously, some of the PMIs around the world were significantly affected because of the supply chain disruptions coming from Japan. But Japan has actually proven to us that it has managed to rebound quite quickly. And so we do expect actually the demand from the US to pick up again fairly soon in terms of the second half of the year. And that will also give an added boost to China. And also, I think if there's one other thing I might add on China with respect to the state of the economy, we are still seeing very strong signs of economic growth. The soft landing scenario that we're talking about, we're actually expecting growth to slow to about 8.8% for this year. And that, when compared to last year, which is 10.3, you are just talking about 1.5 percentage points of headline GDP growth. And that, to me, does not constitute a hard landing scenario in China at all.
There have been concerns about local government in China who have borrowed heavily from the central government for infrastructure projects. Could they handle more interest rate increases?
Well, I think that's clearly a worry that the pessimists will flag out. But in terms of what we have managed to glean from the data in China, the problem seems to be fairly manageable in our view. I mean, we are talking about approximately 11 trillion Chinese yuan worth of local government borrowings. As a percentage of GDP on the high side, that is about 1/3 of GDP. But if you look at the balance sheet of the central government, this is really the crucial point, because the debt to GDP ratio of the central government is less than 20%. And if you add on this 33%, in the push comes to shove scenario, in other words, the central government assumes all the debt of the local government, you are talking about a ratio closer to 55% of GDP. And if you look at today's context, there are not many countries with debt to GDP ratio at 55% of GDP. The UK, for example, is about 85, and the US is 100. And of course, European economies are significantly higher from these levels. And I would say that even at 55, there's still a lot of flexibility on the macroeconomic side, on finances on the part of the government. So I wouldn't worry too much about this, over the raising of interest rates, leading to, of course, default scenarios that will again trigger some kind of systemic risk to the banking system. Of course, the pessimists would also flag that the banking system is very fragile in this environment. But I think that the Chinese authorities are fairly sensible. Clearly, they do recognize that the problem exists out there. But on the other hand, they do need to rein in inflation, particularly on the asset prices side of things. And in that sense, they have to do this. They have to tighten the monetary policy, but they will also at the same time provide the safety net necessary so that they do not plunge the economy into a hard landing, so that they do not imperil the banks in China.
And how much was a potential housing bubble in the mind of policymakers when making this decision?
Well, I think that's precisely the reason why, if you look at the history of monetary policy post-crisis, in terms of the recovery period, the Chinese actually have been trying to rein in on bank lending rather than raise interest rates. They have done a significant number of interest rate hikes on the reserve requirement ratios, and this is aimed at trying to restrict the liquidity out there in the system to prevent people from speculating. Now, if you look at China's housing market at this point in time, there's clearly two markets. If you look at the broad Chinese market, prices have only gone up about 13-14% on a year-on-year basis in 2009, 2010, and that is not a bubble scenario in my view. But if you look at the specific cities, as you've mentioned, Beijing, Shanghai, Shenzhen, for example, prices have gone up 50-60%, and that's not uncommon. But what we have been looking at in terms of all the purchases that have happened in 2009 and 2010, we want to know how much the banks have actually lent out to finance mortgages in China. And what we've actually found is that the loans-to-value ratio for property purchases in China is actually fairly low. You're talking about 50% LTV in 2009 and only about 35% LTV in 2010. So in other words, the bulk of the people who actually bought properties in China paid the majority of the sum in cash. So again, I think there will certainly be people hurt in the process, because as with any accelerated increase in prices, and when there's a contraction of prices, some people will get hurt. But I don't think it will necessarily mean that it will lead to a systemic risk scenario for the banks, and again triggering a banking crisis. So I think these are you and I have pretty much covered the three main fears on China at this point in time, with respect to the housing market, with respect to local government borrowings, over-tightening fears. But I certainly don't see that any of these three fears are going to trigger hard landing in China.
Finally, Joseph, the markets didn't react positively at all to this news. Do you think the reaction was maybe exaggerated?
Yes, most certainly. I think it's an overreaction. I think it's quite fashionable right now to be a pessimist. But I think the world is, in my view at least, very much caught on the blind side when it comes to the upside surprises, because we have seen an earlier than expected rebound in Japan, and that has actually helped to ease the supply chain disruption. So I wouldn't write off the global economy so soon. But again, we've covered some of the broad risk factors for China. I mean, I may sound as if I'm an optimist and I'm on the other end of the spectrum. There are concerns, and I would even flag up yet another concern, which is the one with respect to China's corporate transparency. And of course, the most recent case of Sino Forest is very much prominently featured. But again, if I could ask people to wind back the clock and recall 2002 when Enron collapsed, and 2003 when WorldCom collapsed, this is just a case in point that if there is fraud to be had, it can happen any part in the world. It doesn't have to just happen in China, so to speak. But the key concern, in my view, for pessimists looking at China's economy, they talk about all these fears, clearly is missing the point, in my view. The biggest risk, in my view, for China is the quality of the ability to spread income evenly in China, and that we have not seen, because the income distribution has been deteriorating in China. The Gini coefficient, of course, has been worsening, and I think if you look at what's happening in the world today with respect to the Arab Spring and the rise of new media and the impact on politics, I think this is clearly the big risk that the social fabric of China could be destabilized as the income distribution deteriorates further. So it's really the quality of the growth that I'm more concerned about. I'm not so concerned about the headline GDP growth, whether it moves from 10.5% to 8 or 9%. It is still a very respectable rate of growth. I think the biggest risk for China is the quality of growth and the spread of wealth within the economy itself, because otherwise you are staring at a fairly ugly picture when it comes to social stability.
Some real quality analysis there from Joseph Tan, and we'll be catching up from experts from Germany's Commerzbank and Canada's Social Capital in the coming days. So remember to check back into Dukascopy TV. Goodbye.